Financial markets move in unpredictable ways, with periods of calm suddenly giving way to extreme turbulence. Understanding and measuring this volatility has become essential for investors, banks, and policymakers worldwide. One economist revolutionized how we analyze these fluctuations, fundamentally changing the landscape of financial risk management. Robert Fry Engle III was born in 1942 in Syracuse, New York. His path to becoming one of the most influential econometricians of the 20th century began with a strong foundation in physics and mathematics. He earned his bachelor's degree in physics from Williams College in 1964, demonstrating early on his aptitude for quantitative analysis and complex problem-solving. Engle's transition from physics to economics reflected a growing interest in applying mathematical rigor to understanding human behavior and market dynamics. He pursued graduate studies at Cornell University, where he earned both his master's degree and doctorate in economics. This combination of physics training and economic theory would prove instrumental in his later groundbreaking work. During the 1970s and early 1980s, economists faced a persistent challenge. Traditional models assumed that volatility in financial markets remained constant over time, but real-world data told a different story. Market turbulence clearly varied, with some periods showing wild swings, while others remained relatively stable. The existing tools simply could not capture this time-varying nature of risk. In 1982, Engle published a paper that would transform financial econometrics forever. He introduced the autoregressive conditional heteroskedasticity model, commonly known as ARC. This innovation allowed researchers and practitioners to model and forecast changing volatility patterns in financial time series data. The term heteroskedasticity refers to the condition where variability is not constant, and Engle's model specifically addressed how past volatility influences future volatility. The ARCH model revealed that large price movements tend to cluster together. After a period of high volatility, markets are more likely to experience continued turbulence before settling down. This insight matched what traders and investors had long observed, but could never properly quantify. Engle provided the mathematical framework to measure and predict these patterns with unprecedented accuracy. The practical applications of Engle's work spread rapidly throughout the financial industry. Banks and investment firms began using ARCH-based models to assess risk more accurately, price derivatives more effectively, and manage portfolios with greater precision. Regulatory bodies incorporated these techniques into their frameworks for monitoring financial stability and setting capital requirements for institutions. The model's influence extended beyond its original form. Other researchers built upon Engle's foundation, developing variations like the generalized ARCH model, which offered even more flexibility in capturing volatility dynamics. In 2003, the Royal Swedish Academy of Sciences awarded Robert Engle the Nobel Memorial Prize in Economic Sciences. In 2003, the Royal Swedish Academy of Sciences awarded Robert Engle the Nobel Memorial Prize in Economic Sciences. He shared this honor with Clive Granger, who had made parallel contributions to the analysis of economic time series. The Nobel Committee specifically recognized Engle for his methods of analyzing economic time series with time-varying volatility, acknowledging how his work had become indispensable to modern financial analysis. Beyond his theoretical contributions, Engle demonstrated a commitment to bridging academic research and practical application. He founded the Volatility Institute at New York University's Stern School of Business, where he served as a professor. This institute focuses on measuring, forecasting, and managing financial risk, continuing to advance the field he helped create. The global financial crisis of 2008 highlighted both the importance and limitations of volatility modeling. Each of these contributions added depth to our understanding of how financial systems operate under uncertainty. The global financial crisis of 2008 highlighted both the importance and limitations of volatility modeling. While ARCH-based models provided valuable tools for risk assessment, the crisis revealed that extreme events and systemic risks required additional considerations. Engle himself contributed to post-crisis discussions about improving risk management practices and developing more robust modeling approaches. Today, variations of the ARCH model remain standard tools in financial institutions, central banks, and academic research worldwide. Every time an analyst calculates value at risk, prices an option, or assesses portfolio exposure, they likely rely on techniques that trace back to Engle's pioneering work. His influence permeates modern finance in ways that most market participants may not even realize. Robert Engle's legacy extends beyond any single model or technique. He demonstrated how rigorous mathematical analysis could illuminate complex economic phenomena, providing practical tools that improve decision-making across the financial sector. His work exemplifies how theoretical breakthroughs in economics can generate lasting real-world impact, transforming how we understand and manage the uncertainties inherent in financial markets. Through his research, teaching, and institutional leadership, Engle established a framework for analyzing volatility that continues to shape financial practice decades after its introduction.